why does the world need a stablecoin?
For many people, getting a dollar-denominated bank account is a near impossibility. This is the most aspirational product the United States has, dollars as a global reserve currency.
I can't buy a coffee with USDC. Is that something that you guys are also solving for?
Visa and MasterCard are two close partners of ours that have accepted USDC as a native currency on their networks.
One of the other things in the executive order was the establishment of a strategic Bitcoin reserve.
My suspicion is two things will merge: the sovereign wealth fund concept plus seized crypto assets being monetized as the basis for establishing the strategic reserve.
Hi, I'm Dante Disparte, and I'm the Chief Strategy Officer and Head of Global Policy at Circle, and you're listening to the Innovation Civilization podcast.
Just a reminder that if you like today's show, the best way to propagate the knowledge to more amount of people for the maximum amount of benefit would be if you A, subscribe to the podcast on your platform of choice, and B, review the podcast episodes with 5 stars on the platform of your choice. That ensures that the most amount of people get this knowledge for free, and you're helping in the process. With that, enjoy today's show. All right, Dante, welcome to the Innovation Civilization podcast. What a great pleasure to have you here today.
I'm a fan. Glad to be on.
Brilliant. So, Dante, so let's start with the fundamental question, really. And because of our audience come from very different backgrounds, crypto native, non-crypto native, so on and so forth. So can you define for us, just to peg our goalpost, what a stablecoin actually is in the first place?
Sure. I mean, look, the easiest way to describe what a stablecoin is, and then I'm sure during the interview we'll also discuss how not all stablecoins are created equal.
Yeah.
But for simplicity's sake, a stablecoin like USDC, which is Circle's dollar-based stablecoin, is all of the properties, all of the trust, all of the economic features of the US dollar married with the superpowers of the internet. And so I'm sure through the discussion, we'll walk through exactly what that looks like in practice, but that's the basic, easiest way to describe it.
Yeah. And can I ask, when you say combining the US dollar with the internet, so how does this dovetail with something like early PayPal, where I've got money. I mean, it's there in my bank and I'm sending it over basically, right? It's also, I'm sending it over via the internet, right? So as a lay person, I'm just trying to understand what's the, core difference here.
Yeah. So I'm so glad you asked, because actually I would argue this movement of money question actually goes back probably hundreds and hundreds of years. Most of the global payment systems innovations since double entry bookkeeping, was first, invented or solved.
Yeah.
The general payments problem. All of the world's payment systems innovations are really messaging platforms that are decoupled from payment or settlement activity.
Okay. Can you explain that a little bit?
I'll explain. Absolutely. Yeah. So a global network like SWIFT, which is the network that moves money between banks, is first and foremost a messaging platform sending instructions on whose balance sheet to debit or credit in a payment, which is one of the reasons, especially global payments or cross-border payments, remain stubbornly slow and exact the highest cost from often people who could afford it the least. And so, where a stablecoin shows up as a payments breakthrough is that with a stablecoin, you're actually sending this settlement instrument with the transaction, as opposed to the message for a transaction to be executed, and then the transaction follows. And so the stablecoin collapses that into one activity.
Yeah. And just to make it super clear, currently on SWIFT, you said it's a messaging system. So if I send money to you, it says, debit my account, credit yours, and so, or vice versa. And how does a settlement occur currently, basically, on SWIFT or for normal money?
And this is I'm only mentioning SWIFT for at least anchoring the conversation.
Yeah. And it's also the most used
organization. It's also scale.
Yeah.
But this is true of virtually every traditional payment system, including companies like PayPal and many others. And we'll talk about some of the other challenges like the walled garden problem in a bit as well. But virtually every major payment system, even the ones that offer you and me, if we're customers, a very frictionless, very fast, and the appearance of being an instant payment.
Yeah.
All of it is still messaging instructions on settlement and debit and credit. And so we could wrap that largely analog payment systems with technologies to give the appearance of instantaneity and to give the appearance of low friction payment. But the fact is, the payment activity itself is a lag. Now, why is it a lag? One part of the argument is technological, which is that the technologies of moving money have not had major systems upgrades in a very, very long time.
Interesting.
Part of the argument is economic. Is the slower it takes to move your money, and we're talking at the scale of the world economy, $1 trillion. Guess who benefits from slow movement of money? The institutions that are paid to move the money or who gain interest on holding it for you. The float, if you will, waiting for settlements to occur in the global economy is worth trillions and trillions of dollars in revenue to the global payments companies. And then the last piece of the puzzle is largely many of these organizations and many of these money movement networks are themselves fragmented. So, so those three buckets, technological issues, how they make money and the benefit of slow movement of money, and then lastly, the fragmentation are three critical challenges in modernizing money movement.
So I don't think the average person knows much about the settlement process, right? I mean, when I say average person, I mean myself as well. Like all this time, I actually didn't know that it was just a messaging system. When I send my money from bank A to bank B, it's quite fast. But what you're saying is that there's like background activity that happens as a lag.
Yeah.
Right. So can you kind of elucidate on more about what are these settlement networks look like and why are they so antiquated? Like the whole network of traditional banks, clearing houses or institutions, I don't think it seems to me like a black box, at least to the normal person like me. Can you elucidate what it sort of looks like and why is it so archaic?
Yeah. Well, it's a black box, not because of some conspiracy, but because it's complicated. And frankly, here's perhaps a too colorful analogy, but I'll go with it. No one cares, nor is anyone generally an expert in plumbing until the plumbing stops working and the shower doesn't work and other more colorful examples.
Yeah.
And so in some respects, the challenges that I'm describing are financial plumbing challenges.
Okay.
And it's easy in normal course business to think of it as super frictionless. If you're, for example, a customer inside a PayPal, major company with hundreds of millions of customers around the world. And if you have the fortune of being on the inside of the quote walled garden, and I'll explain what that analogy means in a minute, then your payment and your financial experience is instant in the palm of your hands, and it creates the appearance of the money moving very quickly. And that may be very true inside the walled garden of a payments company or a traditional payments company. Where you see the actual technologies and infrastructures and economics, incentives and motives of payments become obvious when you think about payments, either in the context of financial stress or duress, or in the context of cross-border payments. That's where the whole payment environment really breaks down and feels, frankly, analog. So in the context of stress, if you need money to move really fast, but the banking system takes a bank holiday or it's the weekend, then the proposition to the sender and the receiver is hurry up and wait. In some remittance corridors, cross-border payments corridors, it may often be cheaper to board a flight and to fly a large amount of money to the destination or to the recipient. And this is actually true, than to send it through any of the conventional means. And that's partly because of a lack of competition.
Yeah.
It's partly because, again, the money movement networks are largely still very analog. And they're sending debit and credit instructions as messages as opposed to settlement instruments themselves. And so those are just at least a couple of examples. And then maybe the last analogy I'll offer is, the banking and payment system analogizes to the world of telephony back when telephony depended on fixed infrastructure, poles and lines. And the further your call traveled over this fixed infrastructure, the longer distance you traveled, the higher the cost. Banking and payments, a fast payment is a luxury good. So if you want a fast payment in banking, you're going to pay a lot of money for a fast wire transfer, in part because it has that fixed infrastructure, brick and mortar infrastructure, messaging infrastructure that underpins the way money moves on the planet.
Okay. Just to come back to it. So what do you mean by walled garden?
Yeah, I'm glad you brought that up. So the walled garden problem in payments is that inside the walled garden, you get fast, low cost, near instant payment activity, in part because the settlement in the walled garden is done on what is known as an omnibus account in many cases. So a PayPal customer sending money to a PayPal customer, both transactions are settled within the balance sheet of a PayPal.
I see.
That's why these payments companies get bigger and bigger and bigger and bigger.
I see.
Challenge, however, is that at a technological level, and also at a corporate incentive design level, a payment outside of the PayPal walled garden into, for example, a PayPal to a Stripe payment, the two technologies may not speak to one another. And therefore, that transaction now takes time and it takes cost. And therefore, the best they can do is send a message to each other quickly.
Yeah.
And you still have to wait for the settlement to occur. It then, of course, has to also flow through counterparty banks and others. And so the another way to think of this one from using another analogy here is how useful would email be if a Gmail user couldn't send an email to a Hotmail user, to a Yahoo user, to a corporate email account.
Yeah. And or if they send it, it's going to take huge amounts of time. And
Totally.
Yeah.
Totally.
Yeah.
And so to stay with the internet analogy, payment networks today look more like intranets or extranets of value. And what we're pushing for as a company, Circle, and what our new technologies like blockchain and cryptography and token designs allow us to conceive of is an intranet of value, where every connected endpoint in the world for little more than a basic internet connected device can be part of a global instant settlement network where not just payment instructions are sent as messages, but where settlement occurs with the speed of the internet itself. And it's a complete revolution in how money moves around the planet.
Yeah, that's quite interesting, actually. I quite love the email analogy between like Yahoo versus Gmail. I actually never knew that. I never thought of it that way. One of the questions I wanted to ask you was, and maybe you just hinted on that a little bit with the settlement thing, but why does the world need a stablecoin, basically?
Yeah.
Right?
Yeah.
I know, like, I've done an episode before on the history of money. I know that money changes all the way from like promissory notes and like literally seashells, right? Before to like everything else. But I'm guessing as we enter the 21st century deeper, there's something that needs to be better, right? So I guess my big question is, I mean, the world as it is kind of works, you know?
Yeah.
Why on a broad basis does the world need a stablecoin, basically?
Very good question. Very good question. So first, because you have had past episodes in defining money and the history of money, let me just also anchor my response in what is money as well.
Yeah.
Money has three features: unit of measure, medium of exchange, and store of value. One of the really big conundrums of money is that in many parts of the world, the publicly issued money, what is known as fiat currency, derived from the term fiat as in a directive, you're directed to use this form of money, may not be worth the paper it is printed on. And we have many, many extreme examples from Zimbabwe, where the Zimbabwean dollar has historically suffered massive bouts of hyperinflation. And so people are literally carrying millions and millions of dollars worth of a local currency to buy the smallest of goods. And so meeting that definition of money, if I went to a regulator today, a central bank or a financial crimes regulator or a banking regulator with an innovation called money, it's not likely that by today's standards that innovation would be approved for three real deficiencies. And in describing the deficiency, I will set the stage for why do we need stablecoin. One of the deficiencies that regulators wouldn't like about physical money is its transmissibility. It would only go as far as my arm could reach. Not a particularly usable innovation in its physical form for a financial system and a global economy at the scale of the internet that doesn't take bank holidays. The second is because of its opacity, perfect for censorship-resistant payments, the perfect instrument for peer-to-peer economic activity. But because of its opacity, physical money is the currency of reference for illicit activity and crime. Completely untraceable, and there's many an example from public assistance to foreign aid in which a pallet of physical cash is a honeypot for corruption, bribery, and fraud. The third, and this was all true, especially in the pandemic, is that physical money, is a vector for spreading disease. And some countries actually resulted to physically laundering or their
Interesting.
physical money in circulation to halt the spread of the pandemic and the spread of COVID-19. So if those three, both core properties of money, unit of measure, medium of exchange, store of value, were met with the three challenges that I described, then what is the purpose of a stablecoin? On the US dollar bill, the words "in God we trust" are emblazoned. At the end of the day, a $100 bill and a single dollar are both made with the same total cost of raw material. It's the denomination and it's the terms "in God we trust," frankly, plus obviously the military, the independence of our central bank, the global liquidity, etc., that make the dollar an extraordinary innovation. But when you think of the role of a stablecoin denominated to the US dollar, you now then introduce a critical innovation that solves the transmissibility problem of classical payments networks. And then you introduce an innovation that keeps the trust, safety, soundness of the US dollar, and then allows for more reach. And so it's worth spending a second in telling you a little bit about what have stablecoins like USDC enabled around the world. This is a 6-year-old innovation. From the first time we launched USDC through to today, we have tried to have a race to the top in terms of transparency, trust, and accountability, effectively digitizing the full faith and credit of the US banking system and of the dollar itself. And in 6 years, we've gone from zero to availability in 190 countries and counting, based on little more than a low-cost mobile phone with an open source digital currency wallet. Suddenly you have millions of endpoints connected from a bottom up level that can now interact with each other on a peer-to-peer basis, execute payments instantly on an ultra low cost basis. And then all of a sudden you now have this internet of value starting to grow, where stablecoins are the digital thrift of this always on economy. There's another core feature here, which is for many people, getting a dollar denominated bank account is a near impossibility. This is the most aspirational product the United States has, is dollars as a global reserve currency. And so the advent of turning dollars into cryptographic tokens enables anyone anywhere to have a hedge against their domestic hyperinflationary currency, in the Zimbabwean example at the extreme. And so most stablecoin users are actually in emerging and developing countries holding dollars as a store of value against domestic hyperinflationary currency.
That's quite interesting.
Innovation is a total breakthrough. And then you also see now institutions, large-scale institutions, some of them the very biggest neobanks in the world, banks in the world, are adopting this platform ultimately as a wholesale upgrade over the core money movement networks that they themselves find to be too slow and too antiquated for moving money in the 21st century.
That makes sense, really. And the statistic you mentioned about most usage of USDC is in the emerging markets. Is that what you said? I think.
Yeah, indeed. And then for this, the category, the stablecoin, the dollar-denominated stablecoin category, are reaching probably 800 million or more end users, largely in this developing and emerging world, are the bottoms up end users of this digital dollar economy. USDC, we have published now 3 USDC economy reports. We in one of the earlier versions, we learned that something like 70+% of USDC is held off of crypto exchanges, where the crypto exchange use cases, trading and investing and other activities on capital markets, digital capital markets. 75% of it is held by digital wallets off of crypto exchanges, implying low balance dollar store of value, a retail end user base, and a whole host of other use cases, because the other superpower of stablecoins is programmability and composability, which are 2 terms worth describing for the listeners around once you have sound, fully reserved internet native money. The fact that this is software in the end also then allows you to conceive of people building, designing, and composing a whole host of other financial activities like lending, like credit, and a whole host of other services that are now possible once you know that the money layer of the internet not only exists and it's at world scale, but that it also allows then a wave of entrepreneurs and developers and others to program how that money behaves.
That's interesting. So do you mean like USDC, I can actually program that to do something like it only you can spend it for certain vendors and not other vendors?
Totally.
Oh, I see. Okay.
And this is fascinating. I mean, this part, it's funny because like I think of this in some ways as a ladder of economic mobility. The bottom rung of that ladder is if you could pay someone, and if financial access is a human right, right? The United Nations Sustainable Development Goals, the first of them is to eradicate extreme poverty by 2030. We're not doing very well as a planet on that objective, and we have 5 years to go. And so in my world, a stable coin or digital finance at the scale that we're describing it doesn't solve these endemic and systemic world problems on their own. But what technology can often do is show us where status quo is falling short. And so how do you reach the 3.4 billion people who are underbanked or unbanked in the planet unless you could extend banking to them in digital form? And so the stablecoin does that with dollars and with other currencies. The mobile internet has done that with connectivity and basic access. Mobile wallets, almost all of the successful ones are open source. There's literally millions of mobile wallet applications built around the world that are all open source. Now allow you and me not just to be beneficiaries of ultra low cost payments and access to dollars, but to be entrepreneurs and fintech developers in our own right. There are millions and millions of people around the world today. And Circle is really helping drive this developer ecosystem who are able to build on public blockchains, the shared ledger for this economic activity, and they're able to then build wallet environments and other financial services using what are known as smart contracts.
Yeah.
And then leveraging the fact that you could now compose all of this internet economy in completely new ways.
Yeah. That makes sense, really. What do you make of, since you mentioned like some of the kind of emerging markets and mobile money, what do you make of some of the innovative mobile money kind of systems like M-Pesa and others in the emerging markets, right? How are they like, I'm guessing they use traditional systems, but just pair that with, I guess, mobile versus USDC.
I mean, one, frankly, all of us who are in this industry owe huge debts of gratitude and homage to mobile money networks like M-Pesa. And the experience, and frankly, in my life and in my world, a lot of my conversations are with cross-armed policymakers and regulators who look at me and go, well, Mr. Disparte, I have Zelle. I have Cash App, I have Venmo, I have, and I look back at them, and inside, I never say this publicly, but I'm thinking to myself, that's because you won the postal code lottery, and you happen to be a member of Congress or a senator who doesn't know any other experience but being fully banked. Now, when you flip that on its head, though, and you look at the experience of M-Pesa's emergence in East Africa, in the decade prior to M-Pesa, many countries, Kenya included, had really insidious rates of underbanked and unbanked populations. And in some cases, just the sheer geography and size of so many countries around the world necessitates payment systems innovations in order to reach people, because brick and mortar banking not only is expensive infrastructure, it's slow to build. And so the advent of mobile money like M-Pesa really pays homage and shows the art of the possible when these types of networks reach scale. The challenge with an M-Pesa, however, is that if you wanted a member of the Kenyan diaspora living in New York City wanted to send money back to Kenya in an ultra low cost basis, there wouldn't be great ways to do it because M-Pesa's infrastructure, not unlike, for example, the PayPal example I used a moment ago, would be a walled garden, albeit an incredibly efficient one.
I see.
Would be a walled garden.
I see.
Stablecoins now enable, though, is that a wallet owner in New York, Kenyan diaspora, part of a diaspora community, wants to send money back to their family in Nairobi or anywhere else in East Africa. M-Pesa would have to accept a stablecoin like USDC on the receiving end in order for what is a very efficient payment network domestically to be a part of a very efficient global payment network that would allow us to conceive of that payment not only being instant, be near free. The cost of the transmission of the data might have a higher cost in that transaction over time than the settlement itself. And so that's the use case that you're seeing proliferate around the world is that instant peer-to-peer payment.
Yeah.
And the analogy there is exactly what mobile messaging platforms have done, like WhatsApp, to information and global communications and peer-to-peer sharing. We're seeing a total global proliferation of stablecoin powered and USDC powered wallet networks and remittance corridors being enabled in this manner.
That's interesting, actually. I've never heard of remittance corridors, so to speak, based on USDC. So are you saying that you guys are working with consumer interface wallets or consumer interface banks, right, for emerging markets and onboarding them to USDC, and I can actually send that? Is that happening right
well,
now?
and let me explain this one. Let me explain this one, because this is where not only it gets really interesting, this is where you start to truly unlock the world's most important cash flow. Just to set it into perspective, official development aid, ODA, is government to developing country and humanitarian assistance, is flatlined. Totally flatlined. And it has been for years, meaning the UN and the World Bank and these types of institutions, are operating on the same total size balance sheet in order to prop up the development agenda and humanitarian agenda.
Even less now. With
totally much
yeah,
exactly. Yeah. And it's a declining number, meaning it wasn't
Correct.
efficient in the first place, but it's a shrinking number in part because many countries, you can't do nation building overseas while your nations are crumbling at home.
Exactly.
And whether you like that or not, that's just the political reality.
Yep.
Most parts of the world are retrenching. America first, for example, is the message the new president is sending to the planet. The European Union is in some respects under duress and strain for the very same pressures of you can't do nation building overseas while your citizens are feeling the pain at home.
100%.
And so the other money flow, foreign direct investment, if you exclude China, is also in decline in some respects, because now you have this trend of retrenchment and onshoring and reshoring. And so the FDI money flows are also going to continue being under massive pressure and declining. And even still, foreign direct investment is going through very well-trodden paths for the last 50 or so years. And they're not moving nearly enough money south of the equator around the world to prop up the development agenda. And so against that backdrop, the single most important money flow in the entire world, and the only one that is in fact recession resistant, is peer-to-peer remittances. Pre-pandemic, remittances, the official reported figure was something like $800 billion. COVID-19 pandemic shaved $200 billion off of the remittance because the sender and the receiver were quarantined, or they were underemployed or unemployed.
Yeah.
And so, not surprising, the absolute explosion of alternative payments and low-cost remittance corridors started to emerge as a necessity. And so what is Circle doing to make that happen at scale? One of the best examples we have is a company called Nubank in Brazil. Nubank is a customer acquisition engine that happens to also be a regulated bank. And this company is extraordinary. They have 114 million customers across Latin America and Brazil. Brazil, you could argue, is an island. On the one hand, has the Pacific Ocean, and on the other, it is ring-fenced by the Amazon. And the domestic payments environment in Brazil is exceptional. But access to dollars, the ability to pay at scale, the Brazilian and broad diaspora being able to send money back home in a low-cost way. So Circle has partnered with Nubank to make USDC available as a dollar account, not as a crypto token, not as a token for trading activity, but as basic dollar account. And Nubank has made this available to their 100 million users.
Yeah.
We now see that replicating around the world, where large regulated institutions like Nubank, and frankly, startups as well, building wallets that support USDC and doing so in an architecture that supports open global payments.
Yeah.
And so it's a total breakthrough in these kind of networks.
And I think that's quite important. Like you said, a dollar account, right? So I live in the UK and I do hold USDC, but it's a crypto wallet basically that I hold it on, right? Not my traditional bank that I hold it on, right? So like it's a question of like when I actually open up my banking app, my traditional banking app, like a Barclays or a Santander or NatWest, I want to be able to see USDC and basically send USDC, right? So my question is also, I guess, as a layperson, is currently I can't do that. Like I can't have actual like traditional bank go and have USDC there. And also I can't buy a coffee with USDC, right? Is that something that you guys are also solving for, or will this be purely just a store of value and transfer of money thing, but not point of sale somehow or cash somehow? Yeah,
it's a phenomenal question, and it's so if you go backwards to where I had started this point. I said it's a 6-year-old innovation.
Yeah.
We went from zero to availability in 190 countries in that same span. I should then also tell you what else has transpired over that same 6-year journey. And we treat this with total humility. This is a very deeply mission-driven company. And we think that, our business is a business of utmost good faith. It's a zero failure mission to deliver infrastructure and dollar settlement that could support all of the use cases we're talking about right now. It is a business of just utmost good faith. We're working with the regulators, the policymakers, the bankers, the central banks, and others to ensure ubiquity and common trust everywhere in the world of this innovation. But we've also seen, to your question about endpoints and the point of sale, we've also seen, instead of this being a disruptive innovation to banks or payment networks, many of the payment networks themselves are partners with us or are using USDC to power their own innovations and future proofing of the walled garden problem themselves, right? It's stand to reason that PayPal, for example, launched a stablecoin construct in order to address this interoperability question. Stripe made one of the largest acquisitions in its history, and frankly, the largest acquisition in crypto of a company called Bridge. Bridge is almost entirely built, originally, its architecture around USDC. And so you're now starting to see these really, really large-scale payments platforms. Visa and MasterCard are two close partners of ours that have accepted USDC as a native currency on their networks. And so to your question of where can I buy a cup of coffee with USDC, well, the answer simply is wherever Visa and MasterCard are accepted. And on the back end, you as an end user or you with your bank need that default selection of a credit card or a debit card bearing the Visa logo or the MasterCard logo, in which USDC it can be funded onto your card. So that point of sale integration is happening at scale. Another good example of just scale integrations is a MoneyGram, a traditional remittance payments company with a network all over the world of cash in and cash out points, is accepting USDC that can arrive in a mobile wallet as a local payment, and you can go to a MoneyGram location and cash in and cash out for the local currency. I think these are all examples of convergence of these innovations and technologies with traditional finance, as opposed to digital assets like USDC and a company like Circle trying to disrupt the traditional economy.
I see it.
I think of what we're doing strategically as completing unfinished work in the financial system.
Yeah.
And going places, again, money could not go if it just remained analog or if your payments environment just remained in a walled garden.
Yeah. Sorry, did you say that if I have a USDC account with a bank, I can get a debit card, Visa debit card to spend that USDC? Is that already there in the US?
This is like, it might be new news to the listener, but to the crypto native operator, it's like several years ago.
I see.
It's old news in some respects. Another way to describe this is, the future of money is already here. It's just not evenly distributed. And if you go to many countries in Asia, the idea of a fully integrated, handheld-based, full financial services application is the norm. It's only when you fly into our parts of the world, the United Kingdom, the United States, where you find our banking and our domestic payments environment is still we still use checks in the United States of America. It costs $4 to cash a check.
Yeah.
To the sender and the receiver. And so some of it is the power of incumbency. Some of it is, frankly, the inability of our policymakers and our regulators to move at the speed of innovation.
Yeah.
But the future of this really totally integrated, device-centric financial services world with frictionless, ultra low cost payments is already there.
Yeah.
It's just almost working its way towards the advanced economies from the bottom up, as opposed to born in the advanced economies for their own consumption first and then export it.
That's really interesting. I just want to clarify something. For USDC, you said it's pegged to the US dollar, right? So does that mean for every one USDC you have, Circle holds one US dollar?
Yeah, let me explain that, because I would be. So far, we've had really an exceptional discussion of how did we get here and what is this stuff and why does it matter, and are we finishing up
USDC
on the global economy. But remember, I said at the beginning, not all stablecoins are created equal.
Correct. Yeah. Let's explain that. Yeah. What do you mean by that? Yeah.
Is not great, right? And frankly, new industries and technology sectors tend to be driven by a lot of jargon and a lot of terms that sound special. And what we really need to start doing is explain the activities. Most end users and most people care about outcomes.
Yeah,
They don't care about how the sausage is made.
exactly.
So stablecoins, USDC is really two things. In order to really fulfill the promise of this being a US dollar born on the internet, Circle, for every USDC in circulation, holds cash, dollars,
I see.
in the safest financial institutions in the entire world. Many of them are what are known as global systemic banks, GSIBs. These are the largest banks in the world. They're the banks that are too big to fail. They're the banks that hold literally the wealth of nations. And so a big portion of USDC is cash. Another big portion of USDC is US treasuries.
I see.
Of a short duration US treasuries, because obviously treasuries could be issued over a long horizon. We hold treasuries of 90 days or less. The treasury leg of USDC is held in a special fund managed by BlackRock, in which the end users of this network and the companies that rely on this network can see the individual serial numbers of the treasuries and the date in which the treasury matures. And so you never ever have to listen to me or my CEO, Jeremy Allaire, or follow us on Twitter for what I call the Jerry Maguire test. Show me the money. And so for anybody listening who has seen the wild roller coaster ride of crypto is heavy on promises, heavy on paper, heavy on democratizing value for everybody, but it's also heavy on risk. And there have been many an example. Terra Luna, a quote, stable and name only coin that was a so-called stable coin that was meant to be scientifically managed with an algorithm to stabilize to the US dollar, blew up spectacularly in the span of 3 days and cost $60 billion of market losses. And so we believe in order for this to serve its purpose of global, instant, always on dollar settlement, for retail, wholesale, and a whole host of other use cases, you cannot just take our word for it that it is in fact a digital dollar. You could take the words of our giant asset management partners like BlackRock, our global banking partners that hold the cash leg of USDC, party audits and attestations issued by not random companies, but the top tier auditing firms in the entire world, plus the way we're regulated. We have been, more than any other firm, the pioneers of the regulatory standards of this emerging Internet of Value. And we were the first to get licensed in Europe out of It's not exactly a domain for regulatory arbitrage. We have the first series of major licenses here in the US and frankly, all over the world. And so that's what makes up USDC. It's trust but verified money. It's a regulatory standard that's more transparent and has raced to the top than peer payments companies. And then it is this highly trusted, globally available infrastructure from the retail end user all the way up to the big institution.
So, just to clarify then, so you guys don't do like a version of fractional reserve banking?
No, and I'm glad you brought this up because there is nothing wrong with the construct of a bank to the extent the bank sticks to its knitting, which is to create credit, to create lending, and it's known as the money multiplier, right? So if you and I put $1 in a bank, the bank then takes, let's call it 80 cents on the dollar, or maybe even 90 cents on the dollar, and then creates credit and lending. And so that's a critical function in an economy. It's a critical function that enables people to buy a house, buy a car, and all of these other critical activities. However, it's also a risky activity, necessitating bank guarantee insurance and a public backstop. And we've learned very costly lessons of the perils of fractional reserve banking, including the 2008 financial crisis, from whence Bitcoin and crypto assets were born originally. And so our business model is to hold USDC reserves entirely in the interest of the coin holders, meaning separate and distinct from Circle's corporate balance sheet and corporate expenses. They're never commingled. And all of the reserves that I described, the cash and the treasury component, is held in the interest of the coin holder. This is a super, super critical feature. And at no point, other than the nominal rate of return on holding dollars in safe assets and in short duration assets, does Circle make loans, make pledges, commingle, or take risks with those reserves. It's been a race to the top in terms of soundness. Indeed, we have had to protect USDC from bank risks and bank failures and challenges in the banking system itself historically.
Yeah.
also had to protect this asset from risks of U.S. political budget debates in Congress around, the debt ceiling crisis that we've had 80 times in our country's history. And so when I say that this is the safest form of dollar settlement payment systems on the planet, it genuinely is, in part because of all those designs. Now, the last quick comment I would make on this subject is that the new legislation that's being proposed in the United States, the Genius Act, which just marked up in the Senate, if a bank wanted to issue a dollar stablecoin like USDC, the bank would have to do so from a separate balance sheet that looks more like Circle and less like the bank's balance sheet, precisely for these reasons.
Okay, so it's much more safer, more risk averse, and so on and so forth compared to the fractional reserve banking they would do.
But it serves different functions.
I see.
Just to be clear, the bank is giving you credit and lending.
Yeah.
Digital dollars should be giving you store of value, medium of exchange,
I see.
unit of measure, and a digital dollar then gives you the transmissibility of information on the internet. And so when you marry those two things, that's how you build a 21st century digital dollar.
Yeah. So what I was curious about, so you mentioned about USDC being internative form of the US dollar, and it kind of assumes that the faith in the US dollar as a world's reserve currency needs to be intact, right? So as a company, do you guys see that going forward as a dependency that you would like to keep or get rid of, or geopolitics and so on means that stuff can happen, right? I mean, the pound sterling before the World Wars was the reserve currency, and then so on and so forth. So I'm just trying to steelman the Bitcoin maximalist argument, basically, right? And how that compares. So I don't know. I'm sure you've thought about it. So what do you think of that?
Yeah. I mean, to be frank, the only reason I'm in this business, and the only reason I've endured the arrows and the cross and the challenges of the Libra journey to the Circle journey is because in the end, the very likelihood of the dollar being potentially dethroned as a reserve currency are the actual stakes. And so it's a reasonable statement to describe this in a decade-long span as a digital currency space race, an intense, whomsoever makes it first wins and defines the future of money, of the internet, of economic access, of the 3.4 billion people at the edge of the global economy. That is a race I don't think we want the Western world to lose. And 7 years ago, the global response to the emergence of stablecoins as an innovative structure that could digitize a national currency and then reach the scale of the internet terrified people. It terrified central banks, it terrified regulators and policymakers and the bank lobby. And they spent the better part of 6 years trying to literally kill the innovation or at best ring fence it to very limited economic activities. An economist at the Bank for International Settlements wrote an article in the Financial Times in which 3 policy options were laid out. Let it burn, contain it, or regulate it. And so it is vindicating to look back at the benefit of hindsight. And you can now say USDC has gone from 0 to nearly 60 billion in total circulation. We have processed more than $25 trillion of total payments since inception on this new infrastructure. And now increasingly, the United States under this new administration and in the Senate and Congress is starting to finally understand that this is a national security imperative and it's a national economic imperative to ensure that the dollar's role over the long run is preserved as a global medium of exchange. And that's not going to happen if this is a lawless sector, nearshore, offshore, with zero obligations to privacy, financial crime compliance, anti-money laundering, other norms. We need to respect the rules-based system.
Yeah.
We're also going places where dollars cannot. And so I have a paper that I wrote for the Bretton Woods Committee talking precisely about this question of the longer range issues of how do you protect the role of the dollar on the internet. The thing that has motivated more than 114 central banks around the world to talk about so-called central bank digital currencies was precisely the advent of digital dollars reaching this type of scale.
I see. And
my analogy for the CBDC or central bank digital currency conversation is aviation safety authorities don't fly planes and build jet engines. Instead, they help create conduct in the sky, and as a result, we have competition. Now, if you fast forward, I would love to see a set of standards amongst central banks in different currency regions in which private sector innovations from banks and non-banks can compete on a rules base, digitizing currencies around the world so that those currencies can then interoperate in a lower friction, higher trust, faster way. Because your and my financial needs don't take bank holidays, and our traditional economy does.
Yeah. It's interesting because I was reading Trump's executive order on this, and it actually prohibited the establishment of a central bank digital currency in the US, right? So it's very much playing to the tune of what you're kind of mentioning in that way.
I feel partly responsible.
I see.
Partly responsible, but let me also qualify why I think we need a more nuanced approach here.
Sure.
Partly responsible, and I even wrote a paper titled "The Case Against CBDCs" in the International Economy Journal. The reason I feel a very strong sense of we lost the plot in the United States and in many Western countries, because the second you start taking a taxpayer-funded bet against Moore's Law and technology innovation and ingenuity, and you're then, for example, in the context of the United Kingdom, if the Bank of England said, we're going to be the only operator that can digitize money, forget banks and e-money companies and Revolut and all of the firms that are competing, it can only be the central bank, then you're basically telling high street financial institutions, stop innovating. And that's never going to be good for job creation. It's never going to be good for identifying and creating use cases that we don't yet anticipate. And I don't think you could put a taxpayer bet on technology that will require 100 years of anticipation and development. Policymakers and regulators can give us destinations. It was very useful for John F. Kennedy to say, by the end of this decade, we'll put a man on the moon. And a whole cottage industry was marshaled and rallied. So I don't want our central banks to not be in the game of innovating. What I would like them to do, however, is to set destinations. And the CBDC discussion domestically was always used as the reason why banks and non-banks couldn't compete in the first place. Because we'll wait for the next 6 years and eventually we'll figure something out at the Fed. Turns out that wasn't a good operating model. And it turns out if that was the prevailing operating model, then you wouldn't have had this kind of Cambrian explosion that I just described of real world scale innovation around the US dollar. And so I think the president's message is a good one because it at least allows for Congress to finish the job of getting legislation in place. It continues to enshrine a role for the banking regulators at the federal level, including the Fed, on setting the rules, kind of like my aviation safety analogy, for competition in this category of money. But if we just take the term CBDC and we understand it to be the retail variation, most serious people would agree with me that it isn't a solution looking for a problem. And at worst, it's a form of money from which people could be deplatformed, and the privacy issues, logical issues are nightmarish.
Yeah.
It should scare people listening that when the only major central bank to issue a central bank digital currency is the People's Bank of China, they actually chose an architecture distinct from blockchains and distinct from the one I'm describing, in part because the privacy features of blockchains are too powerful. And ultimately, the form of money that the Chinese central bank is trying to roll out is in some respects a very controlled form of money.
Yeah. And did you say that the architecture that USDC is based on is open source?
Yeah.
Okay.
USDC is on 18 blockchains and counting.
I see.
Each one of the blockchains on which it's available is universally accessible financial services shareware in which, developers, builders, and beyond are able to plug into. And then there's a whole host of other technologies we're making available to effectively make the blockchain part of this stuff fade to the background, like our cross-chain transfer protocol, which is a really cool
That's quite interesting, actually. So does that mean that, say, the Bank of England, can I basically start getting cash, pound sterling, putting it in a vault, and start issuing pound sterling DC, basically online money, and it's obviously going to be on the same rails as USDC because it's open source. I mean, theoretically, is that possible? Or
I'm glad you're bringing this up too, because it's actually the rails that matter more than anything else. And so I've been full of analogies on this interview today. I'll give you one more to talk about digital currencies and debate whether it's a central bank digital currency, a tokenized deposit, or a stablecoin that is the construct.
Yeah.
But ignoring the rails would be the equivalent of building a high-speed train engine, only having the engine and not caring at all about the stations and the stops.
Correct, yeah.
And so the rails is the breakthrough. That's why it's useful to think of central bank digital currencies as an intranet or an extranet. And it's useful to think of stablecoins as an internet. But in precisely the design you described, if the Bank of England said, we want to encourage a rules-based competitive environment for digital pound sterling, then they would say, we will allow companies to be regulated to conduct this activity. We will not tell them which technology rails they could use. We'll be tech neutral. We'll regulate the activity and the risk, not the technology. But we want all of these entities to operate on the basis of meeting the policy and the monetary policy objectives of the Bank of England. Now you can envision a world in which the proliferation of digital pound sterling becomes available. Anybody with a native mobile access wallet, and to frankly any person anywhere in the world that would like pound sterlings in this digital form. And then you take off, this complete Cambrian explosion is now made possible, denominated to one of the most important currencies and historically important currency in the entire world. I even wrote parliamentary evidence to that effect. When the UK Parliament was studying the merits of a central bank digital currency, I wrote a strongly written letter to the parliamentarians saying, you know, if I were you and if I were to do it, I would incentivize this free market approach and this rules-based market approach as opposed to this top-down, only the central bank shall. And guess what? You look back at the benefit of the 6 years since. And this whole industry has taken off. We've hired thousands of people. We've supported trillions of dollars of economic activity. And nowhere in sight is the pound sterling in this competing, uploading your national currency on the internet. In part, the domestic policy environment in the UK has been stuck. And I've done an enormous amount of transatlantic advocacy in the UK and in Europe and elsewhere around the world to ensure that the policymakers and the central bankers understand the opportunity. The conversation has been too risk-based.
That makes sense, really. Just staying on Trump, by the way, and the Trump executive orders and policies and stuff. So one of the other things in the executive order was the establishment of a strategic Bitcoin reserve. What's your take on that? Basically?
Yeah, I mean, first of all, it's a good question. That executive order was accompanied with a few other initiatives, just to kind of provide the listener with some perspective. Because obviously, there's an enormous amount going on in the world. There's an enormous amount going on in the world of technology and President Trump's agenda, both for AI and digital assets and crypto. Earlier, before the strategic reserve was announced, an announcement was made about the formation of a U.S. sovereign wealth fund.
Yes, correct.
Something that the Commerce Secretary and the Treasury Secretary jointly lead in time. The United States, like many governments, is a holder of billions and billions of dollars worth of seized crypto assets. And so the first step of populating a potential crypto asset strategic reserve would be to, instead of having those crypto assets seized and not monetized by the US government, there's an opportunity to hold them even while they're seized. And the gains, the appreciation to somehow then be a tax neutral way of converting this asset into this liability, if you will, into an asset. So on that score, the concept of a strategic reserve makes a lot of sense. And I think the executive order and frankly, the post-executive order commentary coming from the White House and from the crypto czar, David Sachs, and his colleague, Bo Hines, has all been very well reasoned about the approach that's being taken here. I don't believe, and I think most people, and I think the administration probably agrees, that we should take taxpayer money and run a bet on taxpayer money in crypto assets and alternative assets, especially when one of the stated objectives of this administration is to lower the debt burden in the United States, which is not sustainable. And so my suspicion is those two things will merge, the sovereign wealth fund concept plus seized crypto assets being monetized as the basis for establishing the strategic reserve. So interesting. We're not alone. The UAE and many other countries have followed a similar.
100%,
The UAE isn't laden with debt, and so the UAE can take direct investments in some of these alternative assets. But you can't have the economy of the future unless you have the money of the future. Would be my message to the public sector.
That's quite interesting, actually. 100%. But I'm guessing like the reason it's strategic, basically, obviously, is because of the reasons you mentioned. There's like lots of Bitcoin and other currencies, which they have right now, seized because of things happened. But also, like, if I was to think about what's the future of money in terms of like currencies, right? Bitcoin is something that's just happening in a decentralized way, and going back early on in what money means is what two people find valuable, right?
Yes.
Whether it be a barter system, you've got a cow, I've got a camel, and to me, your cow is more important, and the other way around, and we will just exchange that, right? So Bitcoin, I guess, is one of those things in a decentralized way, obviously not with the blessing of the US government, has just kind of been all around, and people use it and so on and so forth. So if I was the US government and, like you mentioned, I want to keep the dominance of the West, or let's just say the influence of the West, right? There's two things I would do, or I would kind of focus on. One is USDC, right? Or US kind of dollar digitized. And the other is basically BTC, right? And control of BTC as much as supply as possible, right? So just from a lay person's perspective, I think that's what might be going on in someone like David Sachs's head, and so on and so forth, right? Yeah.
Well, the answer is no, at least in my personal opinion.
I see.
And if you were the custodian and issuer of the world's largest, most successful hegemonic currency, reserve currency, the US dollar, born in equal measures because of the post-World War II modern financial system, and born in equal measure because of the full faith and credit of all of the economic activity, entrepreneurs and banks and economy and others underpin, and then the whole speak softly and carry a big stick piece of the puzzle. We talk about soft power of the US dollar, but there's also hard power.
Yeah.
You don't weaponize a currency, you weaponize the rails on which a currency rides. And some people, Russia, for example, with the Ukrainian war, has been at the receiving end of what that soft power looks like when you impose sanctions and so on. And so I wouldn't think that anyone in the Treasury Department, the Fed, or the US government, and frankly, anywhere else in the American and global financial system, would correlate a digital gold equivalent asset like Bitcoin to a real world, real economy asset like the US dollar. And so most of the innovations around the movement of dollars, including everything that we do as a company, is around going places where dollars could not go if they're being trapped in walled gardens or stuck at the speed of the brick and mortar banking system. And so the fact that there's, the whole of today's successful generation of stablecoins all reference the US dollar. Varying degrees, and the legal frameworks that are coming will level that up. That's how the Western world will win the digital currency space race, is through rules-based free market competition and entrepreneurialism. And that is a race well underway. And what BTC has done as a breakthrough innovation in alternative assets is give people, for little more than access to that same basic internet connected device and a self-hosted wallet, the ability to participate in an asset that accrues value over time. But I wouldn't connect the two. And I think most central bankers see this way, through their national currencies. Because BTC, and frankly, why stablecoins were born in the first place, is it has failed the payment system test.
True, that's true.
Because of its volatility. And Bitcoin Pizza Day is a famous example of buyer's and spender's remorse. If you bought too much pizza with your Bitcoin, and then you learn the next day that you bought $80,000 worth of pizza, not a particularly powerful breakthrough in payments. And so it should be notable that all successful stablecoins reference the US dollar, and all crypto asset trading activity is priced in dollars. And the dollar is the reference currency of digital assets markets as well.
Yeah, that makes sense, really. I want to quickly jump onto something you mentioned about the emerging markets, right? So you mentioned about if I'm a shopkeeper in Zimbabwe and I want to sort of hold my currency instead of the Zimbabwean currency, local currency, which is volatile, I would just hold USDC, right? And that way I hedge against inflation and so on and so forth, right? So if that happens enough all across the world for different countries, what does that mean for the local currencies for those countries, basically?
No, it's a very serious question. We take it very seriously. I have been on the receiving end of the hardest forms of these questions being asked And so I appreciate doing this in polite company. It is a real concern, right? Just this week, I was speaking at the World Bank Group in a public event. One of my colleagues on the panel was describing the fact that we don't live in a supranational world, and that this is supranational internet money, and that one person's regulated digital dollar might be another country's encroachment on monetary sovereignty and their monetary policy.
Yeah, 100%.
And we have capital controls and all of these other things.
Correct. Yeah.
The shortest answer for the world to address this isn't to close its eyes and to will it away and to try to
Manifest it doesn't exist. Yeah.
pretend it does not exist. The best answer, back to the Financial Times article of let it burn, regulate it, or contain it, is actually to regulate it. And the more you regulate the endpoints on which this digital economy depends, which the technical term is virtual asset service providers. The companies that provide mobile wallets that support stablecoin payments and crypto payments and store of value and all these other use cases have a category. They have a regulatory category. And the more you regulate the endpoint of the internet economy, the more you will then enable it to conform with the rules of your respective jurisdiction. Privacy, financial crime compliance, and be it integrations with the banking system. And so I think that's also the best pathway for a central banker to ensure that its monetary policy comports with this new internet economy. And so many people are afraid of, stable coins could be pathways for digital dollarization.
Yeah.
And I would argue that many countries, especially developing and emerging countries, should accelerate the inflow of stablecoin denominated payments into their economy, because who's the biggest loser in that money flow? It isn't the receiving country that gets faster inflow of hard currencies that will increase the purchasing power parity of the recipient. It's actually the money movement networks that are the biggest losers in that value chain. Same way that, M-Pesa increased the banking rates in the economies that were the first to roll out M-Pesa. The Central Bank of Kenya, the former governor, told me I didn't send a check during the COVID-19 pandemic. I could rely on this ultra fast, domestic payment network and regional payment network to get money to people really, really fast. And so stable coins allow us to envision that at scale. And foreign receipts of hard currencies is a really critical piece of the development puzzle at the macroeconomic level for many countries. And stablecoins allow us to envision getting hard currencies to people faster, lowering the cost of the transmission in the first place. And the real neck to choke isn't the stablecoin issuer in that construct. It's actually the local virtual asset service provider, neobanks and banks, who onshore those payment activities.
Yeah, that's quite interesting, actually. Because I was thinking about this as well from the perspective of foreign exchange reserves that these emerging market central banks actually hold, right? So if you're a small country like Kenya, you would have foreign exchange. The central bank of that country would hold foreign exchange in US dollars, right? To pay for imports and ensure the stability of the currency and other stuff, right? So I'm just wondering, like, having an inflow of USDC into Kenya, how does that beneficially affect your foreign exchange reserve, or it might not have anything to do with it? I don't know. As a layperson, I'm just thinking out loud. Yeah.
No, it's a good question, and it kind of gets to, at least thematically, something that has come through in our conversation, which is that we could either conceive of this as a disruptive technology, or an augmenting technology.
Yeah.
And my view personally, and you could start to also see this adaptation from the central banking community as well, who are really critical stakeholders. I mean, many a crypto company has come and gone pretending that the central banks were somehow not unmovable objects in a real economy. They're unmovable objects, they're critical stakeholders, and you're starting to see some really interesting central bank innovations around payments and alternative payment system structures. For example, the European Central Bank is recently put out policy positions saying non-banks can have access to holding cash directly at the European Central Bank. Here in the United States, similarly, the Federal Reserve, not only because of the executive order, but also put out efforts to increase fast payment systems domestically. And if we think of this as public-private infrastructure, then it ought to also benefit public sector innovations with payments. And so The Brazilian central bank is another great example where their domestic fast payments innovations, projects like Pix and many others, support near ubiquitous payment activity globally in the country. But then the question of how do we then ensure interoperability with regulated international stablecoins into their jurisdiction? How do they interplay with a company like Nubank, which is a major player in the Brazilian economy? All of these questions will show that this is an innovation of convergence, opposed to an innovation of disruption. And there, maybe my last quick analogy and quick comment is cloud infrastructure was terrifying when it first came around.
True.
And not a single IT department or company or public sector authority would have given up easily the fixed infrastructure and the physical infrastructure of their server farm and their IT teams.
Of course. Yeah, it was a trust-based
Part of it was selfish because of job dependency. Part of it was real because the technology was new. We'll look back, hopefully not long from today's interview, and look back at the emergence of regulated stablecoin powered activity, corresponding open blockchain infrastructure, and corresponding digital wallet infrastructure, and call it a currency cloud. And that at first it was terrifying, but over time it's absolutely essential. And it will be hard to envision that both public and private sector, entities and interests and people will opt out of that digital economy because it's doing things that you and I could not do with our money.
Yeah.
Our money just stayed in its traditional forms and in the hands of its traditional entities.
Yeah, that's really compelling. So would you say, if I'm to fast forward to 2100s, basically, what is the vision of the world that Circle sees, and you would hope for, basically? Explain to me the average person's life and then so on and so forth in terms of spending money and storing money and all around that. Yeah, so paint me a picture in 50 years' time.
Yeah, but look, 50 years from now, I think the good news is we won't have to be encumbered by the jargon and the terms of art. I wrote an article in Forbes several years ago, actually, that said when we stop talking about blockchain, we could change the world with it.
That's true.
And I think certainly within 5 years from today, but if not 50, you could envision a world in which every single person on the planet, partly because it's a human right, has total financial access. The access question and the cost of financial access has been driven to zero, in part because companies like ours and innovations like these are all now possible.
Sure.
And they're the subject of an extraordinary race and competition. And so that would be like big objective number one, is that everyone everywhere as a human right now has the technological access to financial services in an integrated and comprehensive basis. The second question, or the second general point, is that it then genuinely works, and that we could then conceive of not just basic access, but moving people up this extraordinary ladder of economic activity where each rung represents credit and lending. And then there's all of these other adjacent innovations, like, for example, digital identity, which we did once, which are now ubiquitous. And with that, we have a whole opportunity to conceive of innovations, industries, jobs, and opportunities of the future, where the prospect of, instead of the World Bank president spoke this week and said something really powerful, which is that talent is everywhere, opportunity is not.
Sure.
And one of the things that fuels mass migration, be it at the southern border of the United States or across the Mediterranean and across the world, in 100 years, if we haven't solved for ensuring that talent is everywhere and opportunity is also everywhere, we're going to live in a very, very dark planet. And thinking of financial access at the scale that we're trying to do at Circle allows us to re-envision both talent and opportunity being hyper-localized, a little more than a basic internet-connected device.
Yeah, no, I love that. I love that vision. And this is my last question, basically. So you're obviously heading the policy at Circle. You painted the vision in 50 years' time. What specific regulations need to be in place to make this possible up next? Yeah,
I mean, look, the simplest thing is, one of the reasons, I think, despite all the criticism we give the United States for being an anti-crypto country, is that at a minimum, our policy posture towards innovation is, if you're going to do nothing, at least do no harm. And so the simplest regulatory and policy analogy historically would be the Internet Act. And the second we destigmatized the copyright and the content creation inhibitions of letting the internet flourish, we now have trillion-dollar companies, and categories have been entirely defined by a single act of Congress. And I think Congress has in front of it here in the United States the same opportunity to unlock multi-trillion-dollar industries. So when people look at the United States, we talk about American exceptionalism. When you talk about America and technology policy, I would call the last decade the era of American gradualism, which hasn't done us any good for being technophobic towards emerging and exponential technologies. And so the era of American gradualism could come to an end. And the single piece of legislative construct we need, beginning with regulating this digital currency innovation first, is the piece of legislation that enables the Internet of Value to genuinely take off. And with that, the 100-year mark that I've just described, I think is entirely possible.
Yeah, that makes sense. Really brilliant. This is such a great conversation. I genuinely learned so much about money just from an hour ago. My version to the version here is just completely different. So thanks, Dante.
Thank you
for being on the podcast and being on the show, and all the best with that 100-year vision that you laid out.
Onwards, my friend. Great to be on. Thank you.
Brilliant.